Well, joining us now to react to the breaking news, we have our Bloomberg best forecaster for GDP. He's the best on forecasting economic growth. He's John Herrmann. He's a senior fixed income strategist at State Street Global Media Markets. And John, you had looked for, I think it was, I'm on my papers here, 3.4%, right? So you were actually slightly below the consensus.
Slightly below. So we came in pretty close to the number. I'm just looking through the report, and I'm just trying to grab a few key items here. What we really need to look at, part of our estimate included a projection that inventories would actually pull back and subtract maybe about 1.5 points from GDP growth. So we're just trying to verify that. But if that's the case, then this economy is really well positioned for growth next year. Because here's the key point. We have decent, we're getting some decent job growth. We have decent consumer spending. Banks are lending again. And what we want to do is just move those inventories better in line with sales. And that should position first half growth to a very solid inventory ramp, get that ISM manufacturing number above 60. The economy would then start firing on all cylinders.
This is key, and let me give you that number because I'm looking at the headlines.
Okay.
You minus out, subtract the inventories, John. The economy actually grew 7.1%. That is the most since 1984. That's exactly what you're talking about, right?
That's fantastic. Yes, we were looking for final sales to print close to 5% is what our estimate was. So this actually beats our estimate. And I went back, just like you did, and I rechecked the last, strong gains in final sales. The last best gain was in the first quarter of 2003, and this number eclipsed this. So as you're saying, we have to go back several decades to get a growth rate this strong and this constructive.
Okay.
So now we have to look ahead. Okay, I think we should look ahead, realize that we have excellent federal tax positions put into place.
Right.
This economy should really begin to grow this year.
No, you've got dropping government investment and also fixed investments, particularly in technology, is not looking that great.
No, Betty, I take the exact opposite of Mike's interpretation. So here's the thing. First 3 quarters of last year, business spending, for example, was running at a 20% clip per quarter. That's astounding. We needed just a little bit of a pullback. Businesses, restored profits, maintained very excellent profit position. And now, with President Obama's new tax relief program, there'll be extra bonus depreciation in 2011 and in 2012. So we look for business CapEx spending to really pick up once again in 2011 through 2012. So it'll be a main driver of growth. The other features is, we had inventories a little bit out of line, a little bit too aggressive in the third quarter.
Right.
But what we've done is we've maneuvered them from the business standpoint. We maneuvered them very rapidly into line with sales. So that points to a very strong first half growth.
Hang on, Mike.
I'm not going to argue with John. John, I'm not saying that this is what should have happened. I'm just saying it's what did happen in terms of business spending. And you're very right about the tax credit probably will help. Also, that consumer spending number up 4.4% better than expected. And now we all have more money from the payroll tax cut. So that should add or could add to consumer spending in the first quarter. So the mix of this GDP report is really good, and it sets us up for very strong growth in the first quarter.
It is absolutely. It is probably one of the best mixes that we could really have to start the year because we have no inventory overhang. We have consumers are just a little bit ahead of their skis in terms of spending to income. Spending was 4.4, real income growth, less transfers was 2.3. Okay, so consumers will just rebuild savings a little bit in the first quarter, but they'll be ready to go in the second and third quarter.
But how do we know? How do we know, John, that they'll be ready to go? How do we know that?
Very simple. Very simple. We have consumers will be getting via President Obama's stimulus package. Consumers will be benefiting upwards of $400 billion of relief and assistance over calendar year 2011. Very, very strong stimulus, first thing. Second thing is banks are starting to lend again. We can see the easing of credit card conditions. We're also seeing hiring picking up. We're seeing a steady turnaround in jobs and income. So things are coiling in the right way. We ended the year with the right mix, and there's very few imbalances and overhangs to impede growth this year. So for this year, we look for actually a two-tier. Betty, you have to hear this. We're looking for a two-tier set of growth.
Right.
First half, we should average a little over 3, but in the second half, we should average well over 4%.